There's a couple different ways to use them. A lot of traders use them to try and trade in between, buy when it hits the lower band, sell when it hits the higher band. That's one way to use them.
Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by Charles Schwab. We have Dr. Mikhail Melnik on the line, and he is an economics professor at Southern Polytechnic State University. How you doing today, Doctor?
I'm well, thank you.
Thanks for coming on the show here, and it's time for us to talk a little bit about academics here, and we just have to go right, to the current interest rate environment. Long-term rates. I mean, are they going to stay cheap forever?
Well, that's a very good question, right? Well, let me begin by saying this. First of all, a little disclaimer. I'm an economist, so one should never listen to an economist for any financial advice because we've been historically very bad at predicting the market. With that in mind, the long-term rates are extremely low today, right? If you look at the history of the United States, for the 30-year bond, the 30-year Treasury bond, to pay 3% in nominal terms is somewhat unusual, right? And last year, we saw the market react to that and actually pull the rates up by the end of the year. At that point in time, I made a forecast for Bloomberg in the Bloomberg Survey, actually projecting that the 30-year rate would decline to 3.4% by May of this year, and further declines would be observed throughout the rest of this year. I remain with that forecast. Let me kind of give you a short answer first. And the short answer why we are where we are is very simple. The U.S. economy is doing okay, but not great. The global economy is not even doing okay. So that makes the U.S. an attractive investment alternative that attracts capital from overseas to the U.S., and in particular into the dollar and the Treasury market as well. And that helps maintain those rates low, and that sort of creates that environment. But that's a short answer. If you like, we can spend, as you mentioned, academics earlier, so we can spend a few minutes on an economics lesson and explore it in more detail. But that's up to you.
Okay, are you talking about the Fisher equation?
Well, the Fisher equation is the starting point, absolutely.
Okay, let's start with that. Why don't you explain what it is and how you use it in your analysis?
Okay. Probably every one of your listeners is familiar with the Fisher equation. The Fisher equation tells us how the nominal interest rate for any asset is constructed of two important components, right? The real rate and the rate of inflation. So when we look at, for example, 3% being paid nominally by a 30-year Treasury bond today, with inflation being around 1.7%, the real rate works out to be 1.3%. That's the Fisher equation. Now, why is the Fisher equation important for forecasting future interest rates? When you do forecasting, you really want to forecast the real rate and the inflationary rate, in other words, those two components, separately. You want to examine them separately and then add them up to arrive at the nominal rate. So how would that play out with the current environment? Here's an example. And this is why, for example, I believe that the low rates we experience today, unfortunately, are with us to stay. First of all, we know that in the short run, in other words, within the span of a year to 2 years, the central bank, typically, in our case, the Federal Reserve, typically has a very good control over the real rate of interest. In other words, if you look at the short-term real rates, they're completely under the control of the central bank. It's the long-term real interest rates that become more questionable because that's where you have market forces, and those are actually very complicated. On the surface, you may wish to say, well, it's very simple, it's lending and borrowing, but actually, no, it's not that simple. Companies borrow money in order to invest into capital stocks. So they look at the marginal productivity of capital and compare it to the cost of borrowing. So that's really how the interest rate ultimately adjusts in the economy. So, and that's an interesting point. So let me and feel free to interrupt me if something I say requires a further elaboration.
Okay, we'll do.
Oh, thank you. But in terms of the central banks, we just heard today that the Central Bank of Japan expanded its stimulus. This is the environment we're going to continue to see. In other words, even without Federal Reserve stopping the QE program, that doesn't mean much because the Federal Reserve continues to commit to a low rate environment. And in fact, they said that they will do it for an extended period of time, or considerable period of time, as they put it. That's expected because the economy doesn't justify raising rates. So I know some economists expect that we'll see 0.75 federal funds rate this time next year. I'm a bit less optimistic on that, and I think we're going to continue to see the federal funds rate where it is throughout 2015. So central banks continue to remain accommodated, which means that there is no pressure on short-term rates to rise. Nobody is going to guide them higher. Central banks wish to sort of do as much as they can for their economies, and that's understandable. Another interesting thing is global economic problems actually help the United States in some sense. And we keep forgetting that. For instance, going back to the Fisher equation, right? When we looked at the central banks, when we just mentioned them, we looked at the real rate, the determinant of the real rate, right, or one of the determinants. The other determinant of the real rate, which is very interesting in my mind, and even such economists as Bernanke contributed to that area of economic research, is that the real rate in the long run is a function of the marginal productivity of capital. Now, personally, I have no idea which way the causality clearly goes, but what we do know in economics is that when the marginal product of capital decreases, the real interest rate decreases with it, or vice versa. In other words, there is a correlation. If you look at the U.S., and not just the U.S., but globally, but the U.S. is a good example because the data is easily available. If you look at the U.S. economy over the last, say, 20, 30 years, you will notice that the growth in capital outpaces the growth in labor, nearly 2 to 1. For that, you can just go to the Federal Reserve website, and they report capital stock for the United States. So, and the Bureau of Labor Statistics reports the labor data. So as a result, the capital to labor ratio in the United States has been rising. That has decreased the marginal productivity of capital. What it means is, in a nutshell, what it means is that we're stuck with a low real rate environment, perhaps permanently. And that's an interesting point in my mind that most people seem to ignore because they kind of look at this historically and say, well, the rates were 6%, the rates were 5%, we had the real rates of 2%, 3% just less than a decade ago. Why not see that again? That may not happen. The economy is now addicted to a lower cost of capital. Our business sector has adjusted. And if we were to make any changes to that and drive up the real interest rate, we would essentially invert the curve, the yield curve, and cause serious problems to the economy. So that's your first component in the Fisher equation. The real rate of interest is likely to stay low throughout your and my lifespan, and that's a big consequence because it's or an important. It's something that has big consequences on your and my investment planning, retirement planning, everything. And then inflation. And that's where the foreign economic problems actually help us. I never understood this argument that a low price of oil is bad for the U.S. economy. It might be bad for those who do oil exploration, which is a small segment of the U.S. economy. But broadly defined, it's actually good for the U.S. economy. And when economic problems occur in Europe, in Asia, that weakens the demand for commodities. And that helps us with our cost of production. So economic woes there help us here, so help maintain inflation low. So with that in mind, I think the market's inflationary expectations today are much lower than they were a year ago. And I think today they're more correct. In other words, I don't expect a spike in inflation anytime within the next year or two. And I think that's what the market is now recognizing, and that's what has taken the rates where they are. So in a nutshell, that's it. Now, that doesn't mean we have no inflation, by the way. When I go grocery shopping, inflation is through the roof. But when I go to my Best Buy, my local Best Buy store, inflation doesn't exist. So that's your sort of sign that inflation, that globalization of the economy and those economic problems overseas help keep inflation relatively low in the United States. So that's sort of your long answer.
Okay. Basically, though, isn't the Fed just saying by what they're doing, the way they're acting, that rates aren't going up? We're never going to have inflation. There's nothing to worry about. And, as evidence in the gold market here getting lit up, I mean, it's just non-existence. I mean, maybe we should take that word out of our vocabulary.
What, inflation?
Yeah.
Well, be careful with that. Inflation is like a wildfire, When you try to set it up, you don't know which way it will go. So it's a force you can't control. And central banks around the world are trying to sort of create, not inflation, but inflationary expectations. I don't know if you're in New York City, but there's a prominent economist operating from New York City, Paul Krugman, who's been arguing for inflationary expectations, to my knowledge, for quite some time. And his arguments are logical, right? Because inflation expectations can create spending increases, right? Now, going back to your point, does that mean that inflation is not going to be with us in the future? You can't rule it out. The reason you can't rule it out is because for a foreseeable future, inflation is a low-risk phenomenon. The reason being is that if the global economy remains politically stable, then you have an enormous pool of economic resources, including labor, on the planet that is going to remain cheap for a long period of time. In other words, as China becomes more expensive in production costs and slows down, Vietnam, the Philippines, other countries will replace them. As they become more expensive, other places will replace them. If we have an enormous amount of labor resources still available on the planet at low cost, which means that it is possible for us to control costs of production for a very long time. But remember, reasons for inflation don't just depend on costs of production. They also depend on economic policies. For instance, what would cause inflation to appear in the U.S. dollar very quickly? Anything that would take the commodity market out of the U.S. and move it, say, to Europe. In other words, anything that would replace the dollar as the commodity currency. That would create significant problems. Now, is that likely today? No, because there is no economy, there is no political entity that's more stable and larger than the United States. But does that mean that this is the future forever? I'm not sure. Does that mean that all the money printing we do and all the national debt we incur is not going to cause for further debt monetization later and potentially create spikes in inflation? We don't know. Right now, I agree with you. For instance, the gold market is showing to us that there is stability, right? Because gold is a hedge essentially against the dollar. And what we're seeing is that the last bastion of defense against the dollar is rapidly falling apart, right? Every other bastion has already fallen apart, so now gold is the last thing that was used by investors as a hedge against the dollar. It's sort of crumbling. So right now we see that, but we also know how quickly markets can turn around. So the rational expectation is that you will not see serious inflation in the foreseeable future. but spikes can happen. There are risks. Our national debt has, I believe, surpassed our GDP. At some point, everyone will realize that debt monetization has to be, to some degree, practiced. So, but I think a more logical scenario for us is not necessarily debt monetization, but higher taxation over time, and in essence, slower growth with the debt burden, like Japan, for example.
We have one of your former students here in the office, Garrett Cook. Garrett's on the line here, and he's going to throw a question at you.
Hey, Professor, what's going on?
Well, I'm in sunny Atlanta, Georgia. How are you?
Yeah, I'm doing good. You're just using up all the oxygen we have out here with these long-winded answers, but I like it. I wanted to get your view, if I could. There's actually a two-part question here. Number one is going to be the Russian rate hike this morning and what you think that's going to mean for Russia and the ruble and possibly currency trading. And then on top of that, going with inflation, what's your view with the slowdown on money velocity and the impact that that has on the CPI? Do you think that the way that we're measuring money velocity with people using credit more often now than cash per se, do you think that that has an impact on it, and do you expect money velocity to pick up anytime soon?
Okay. Well, let me begin with the Russian ruble, go in the order in which it is received, so to speak. Russia does a few interesting things today. As you know, Russia is in a little bit of a more, in a slightly difficult situation. And that difficulty arises from a number of points. If you're a U.S. politician, you will say it's the sanctions. Although I'm not sure if the sanctions are the driving force, I think the sanctions actually damage the European Union slightly more than Russia to some degree. But the problems of Russia are more serious. The price of oil, I believe, just dropped below $80 in the U.S. Futures market. That for Russia is a disastrous, or not a disastrous, but near disastrous situation. If you look at their budget planning, it assumed the price of oil, if I remember correctly, above $90. So they've been continuously revising their budget. The geopolitical instability is not a very good factor for Russia. So there is a capital outflow. The solution that Russia does with the ruble, I don't personally like. As you might know, the Central Bank of Russia has intervened in the currency market and has used up several $1 billion worth of reserve this month alone. So I think they quoted a figure over 11 billion within a short period of time, just a couple of weeks. So that's a relatively large loss of reserves. That, by the way, is also one of the factors responsible for the pullback in the gold price. When you think about the price of gold, you think about, in essence, central banks supporting gold and or having supported gold in the last few years. And then those very central banks that have been accumulating gold now are switching to supporting their currencies, which takes a big buyer out of the market. But the support of the ruble is there. Does that mean it's going to be successful? For a while, yes. And if the price of oil reverses, then naturally the problem will go away. But if the price of oil does not reverse, then the ruble is in a somewhat weakened state, and the support of the central bank will only use up the reserves. So, again, to me, that solution is not that great. But if I were in charge of the Russian central bank, let's put it this way, I would probably not support the ruble. I would let it slide, but I would use the funds to support the domestic social programs. In other words, to support those people in the country who are affected by food price inflation. Because a weaker ruble may actually not necessarily damage the export-oriented sector of Russia, but supporting the ruble and using up reserves in this way in an environment where the price of oil is sliding and is likely to remain relatively low for an extended period of time, that's a little bit dangerous. Now on to inflation and credit. when we think about inflation, right, there is sort of a traditional mechanism, right? You go from a money balance to inflation because that money starts being spent, right? So in other words, there has to be a circulation of money, as you said, at velocity of money, or transaction velocity of money. So do I feel that credit changes anything? We've had credit before, and in fact, it was credit that caused us a little bit of a problem back in 2007 and 2008, right? An overextended debt balance of households. We're nowhere near an overextended debt balance of households. Yeah, it's true that spending is rising, credit is rising in the U.S., but it is nowhere near a dangerous level. So from that perspective, I wouldn't worry about it at this time. And also, if you look at the recent data...
We got to wrap it up here. 1 minute, Doctor. We got to wrap it up here.
Oh, I'm sorry.
Yeah, we're running up here against the clock. I just want to know, just real quick, do you have any good stories about Garrett that you can relate to the crowd when he was in your class?
Well, first of all, he was also on the Fed challenge team, so he can tell you. I believe, if I remember correctly, didn't you, Garrett, visit the Fed?
He is hopping. Did you visit?
No, we didn't go to the Fed. We went to New York, and then sadly we lost to Canisius. So no, we didn't go to the Fed.
See, there you go. So he's practically an economist in charge of the United States.
All right. He knows his stuff. Well, thanks a lot for coming on, Dr. Melnik. We appreciate your outlook on the economy, and we hope to talk to you again soon.
Well, thank you.